Hey, good morning, everyone. Welcome to the room. As you know, trading futures involves risk. It's not suitable for all investors. Information in the presentations for educational purposes. It's not a trade signal service, not intended to be financial advice. Hope you're all doing well this morning. As I said in yesterday's market analysis video, the rally continues, and we are off and running here again this morning with another gap up. And on the ES here, you can see broke the 61.8 yesterday. And when we get these kind of run-ups off of lows, especially off of a failed bearish pattern, for example, the down or descending triangle that we were in, like this, you know, when you're expecting the market to go lower and it doesn't, you end up with a lot of short covering as well as almost panic buying in a way, especially for folks who um, maybe feel like they missed the COVID sell-off and just have been sitting on the sidelines, missed the whole run up for the last couple years, or have been sitting on the sidelines since 2008. Um, didn't get in on the housing market, didn't get in the stock market. You have those kinds of FOMO coming back into people's minds, and it's kind of like, oh, we better jump on the bandwagon and get in. So at some point here, we're going to get some reprieve. I did a buy on uh, pretty much near lows, but since then I have not done any more long-term ads. I guess I take that back a little bit in my HSA on the breakout day, just because that's how it worked with the funds transferring in, but nothing else in terms of VUG. We do have Tesla potentially doing a stock split. Amazon and Google have already announced stock splits, so there's going to be a lot of fuel for tech, um, and that you know the potential for what might seem like indescribable rally. And so any pullback would be, I would definitely be buying that from a long-term perspective. If we draw a 50% retracement, like so, we'll just take the swing low before the breakout to whatever today's open. You're talking like a 4,400. That's considerably higher than lows, but at this point, um, the it's almost like the initial shock of the war in Ukraine is worn off, and there just nothing seems to be slowing down this market. So not gonna fight it. Just gonna keep looking for intraday trades. I really don't have any big swing plays on at the moment. I suppose you could call Bitcoin a swing in that I started building a position and it is working its way up to its 50% retracement short. To probably take some off there, but I'm okay uh, holding a bigger chunk of that. But if can make our way up to 51, a 38 up to a 51 is a nice move. But otherwise, been playing it fairly quiet on the retracement front. Um, Couple of 15-minute breakouts last week. Nothing yesterday because we filled the gap at the open, and same with Friday. And then I didn't really have many retracement setups last week either. The last 2 weeks really. Couple on the last couple of Mondays. Last Monday actually was a nice day, but didn't have much else. So, and that's okay. You don't necessarily need to force things, just like trying to force yourself into a short position. I do have a small put position on that. I guess in some senses might have just been a little bit of stubbornness. So I had put one on initially on the 23rd and then just closed it out the next day. We broke above the high. Um, we were not clearly we weren't rolling over. So and then I put a little bit a really small one on with a little bit more time yesterday at the close. So we'll give it. Well, at this point, we're going to need a much bigger catalyst to slow things down. So I've got a little bit of time. I told myself I'd give it till next week, just because when you get into that situation where you feel like market, nothing can take this market down, that's when you want to be a little bit cautious. It's not going to be something expected in most cases. You got priced in rate hikes, the Russia-Ukraine war, all this stuff is already sort of known, and traders have placed their bets on those moves. That's what it means to be priced in. When we look at the VIX, I mean, coming down into the upper teens again, and this is definitely not what I had envisioned a couple weeks ago when the war broke out and gas prices took off. On the one hand, high gas prices are great for innovation. Companies like Tesla, the EV markets, pushing towards the renewables, which will fuel new business opportunities and products and obviously all the car manufacturing and things like that. So um, sometimes you get in those situations and it can actually fuel innovation, which is great, moves things forward, continues growth. But I mean, look at where we are in the S&P. Let me go to the SPX here, and then we'll get into the intraday ES stuff. But if we look at, you know, 4,600 on the S&P, our all-time high is 4,800. I guess you go back to COVID and say, we had the two 2 month sell-off, and I guess it didn't make a lot of sense back then, but that was when I kind of loaded the boat in March, um, and kind of here we are again. We've got these two bearish bars, and we're what two couple of days away from the end of the month, so doing it all over again. So this is why it's very important. My philosophy is to not try and pick a top, liquidate the portfolio, because you can get in the habit of feeling like you have to be getting in and getting out. And when the market does make a sell-off, maybe you look at it as, well, yeah, we're 10, 15% off highs, but we could go 50%. So I'm going to liquidate my portfolio. You sell everything, down at lows, and here we are, much, much higher. So that's just my take on it. All right, let's get into some intraday ES here. So we have a gap up. We are clearly above any recent swing highs. I'm just going to take this off the chart. Now we do have on the daily here, or more like a weekly, an extension high from the highs of pre-COVID to our highs from end of last year. So that extension did trade, and its target is 51.40. So The market by now you should know the market can always surprise you, but should never surprise you. And I suppose one thing I should mention is, I it was either last week or in yesterday's video, I made a comment that I kind of got lucky buying the low or close to the low, but you know in reality, there's always some structure to the trading decisions that I'm making. So when we gap down here on the 24th, we had a 15-minute bar that was trading. We gapped down to the extension long. We closed the first 15-minute bar, and then I bought above the high of that bar. And you know, from a long-term perspective, I don't necessarily have a stop below the low, but that would be, I mean, that's the entry or the setup, if you will. So it's not just like, oh, I'm just throwing out an order here and I'm just going to buy just because the market's down. I don't just randomly throw orders out there. So I didn't want to allude that it was just complete luck. There is a fair bit of um, decision making that goes in that's based off of the technicals of the chart. This is when you know, reflected in my trade log a lot of times is what can be happening with the broader market. So, or let me rephrase that. Sometimes my trade log reflects the opportunities throughout the day and the intraday time frame. So like the last 2 weeks, I didn't have very many trades. So when you go to, let's say, the daily chart and you say, didn't really have too many trades, why might that be? Well, we're getting into this, people might say overbought or overextended situation where we've gone up, up, up with really only one pullback day in the mix. Otherwise, every single candle made a higher low on the way up here. And so, the opportunities start to become a little bit thinner, if you will, as you get further away from lows. That's why buying a breakout is a fine play. Buying a pullback is, in my mind, a little bit better because you're getting in earlier before it's quite so visible. But buying the breakout here would be fine. Even above the high of the breakout day would be fine because then when you look, 4350 and now we're up here at 4600. So getting in early is the key. You want to be getting in when it's quiet and when nobody is talking about it. Been kind of harping on Bitcoin at that 40 or 38 area down here, 38, 39, the uptrend line, building a position, buying, buying, buying. Well, it's not really hot in the news at that point. But now that we're up here at 48 and we've broken out, now it gets the media attention, and then all the late to the party Charlies jump in and keep running it higher, and then we're sitting here with much bigger profits to be looking at exiting. So a lot of times, by the time something is newsworthy, it's too late. And that can be very difficult to restrain yourself from just jumping in. Oh, Tesla's going to do a stock split. Okay, well, you better, if you're interested in getting in on something like a Tesla, you don't want to necessarily be waiting 2 years from now or a year from now whenever the split ends up happening. If it happens this fall, that's relatively soon. But if Tesla gets a pullback, just like we did, when it was trading 750, 700, 800, if you're looking to build a position in Tesla, you don't want to be waiting, waiting, waiting. You want to strike when it's not in the media, when things are kind of down here in the seemingly in the dumps, when people are talking about, oh yeah, see the rally's over and uh, it's all over. Otherwise, you're buying it in inopportune time. So we've got a couple of minutes here. The first 15-minute candle will uh, probably give us our first opportunity of the day. Just looking at the 512 tick chart, I can already tell, we've got a broken halfway back long from the open and then the halfway back short. The full has not traded. We really don't have too much. Maybe the first retracement short touched its 50%, but then we really didn't have much after that. Um, so you can just kind of you get good at looking at the chart and just kind of assessing, okay, at this point we started trending up and then we're trending down. We haven't traded at the halfway back yet. We'll mark it here and we'll get ready to bracket this first 15-minute bar. We're looking at a 46.23 and a quarter to the long side. So I do a buy stop, 23 and a quarter. And then on the short side, at the moment we're at 04 even, 46.04. So that's the one that I'm going to put in first just because price is closer to it. So I watch up here the time as we get close to that 15-minute mark. My time 6:45, and I look at where we are closest to price-wise. The low is 46.04 and a quarter, so I'm going to put the order one tick below that, and then I just come over to my trade ladder here and just drop it as soon as the time clicks or that next bar forms. In rare cases, the candle will close at the higher low, and I'm dropping the order in like on top of it. And it could happen here. We're kind of getting down to it a minute away, and we're trading pretty close to the low. So um, if that happens, I'll drop the order. A lot of times we will tick up. Let's say we break another tick lower or two. We kind of tick around that price. So usually it does end up getting filled, but in rare instances, we're just ripping. And I can think of one instances where it just happened too fast and I missed it. So not the end of the world, but so we're at 46.04, and you're basically counting down. You got 10 seconds, and then I'll just drop that order in, and then I'll go in and I'll drop the high, a 23 and a quarter, and I'll leave those alone, and then I'll start looking at retracement trades. So there we go, 46.04 and 23 and a quarter. Okay. So we'll see if if either of those get triggered. When you have a gap up like this, you tend to have a better chance for movement because you can either come down and fill the gap or gap and go. The third option, gap and flat, is what we don't want for the market to just go sideways, kind of like yesterday at the open. And look what happened. We filled the gap. The settlement closed, so 15 minutes after the NYSE closed at 4 Eastern. In the first 15 minutes yesterday, we filled that gap, and then we just went sideways. So there was no entry yesterday, or I don't take an entry. We can see in the overnight that we spent. Here is close. So spent all of our time above yesterday's close. When we get these extreme NYSE ticks at the open, you just kind of ignore those and start 5 minutes after. So currently our relatively high tick would be something like a 7, upper 7s in that area. 2 to 1 breath, 1500 advanced decline line, those are fine numbers. If they start to deteriorate and we drift more towards the 1 to 1, then then on the one hand, that could lean towards like just moving flat, moving sideways. But on the other hand, if we start to see a one-to-one with an advanced decline line going down, then we're more likely to see a fill, a gap fill. Low ticks at this point are not going to be very meaningful because we're so early in the day. So, um, if I come in here, okay, 642 was the low price. Well, obviously we don't have a low tick at that time because we're like in the process of making low ticks, so getting to the zero line. And that's another reason why giving the market, 15, 20 minutes to kind of settle down gives you some of those reference points, and then you can come in here and start looking for low ticks that line up with low price, high ticks when you're looking to short up near 50%, and kind of correspond the two to help make better entries. I'm going to draw up this long. I don't have an order here, but just visually, it the negative 23 kind of the long takes us to the short, and even before drawing it up, I can just tell that. Yeah, I use a 4-point stop on that 15-minute breakout. And if it fills, I can walk through that as well. And a 20-point target is what I've been doing this year. Just an arbitrary 20-point target. Sometimes we've been getting there it goes. So we've been getting these super strong moves off of the candle. Like let's say we just rip down and fill the gap immediately. Well, I don't want it to come all the way back up and give me the 20 points, take back 20 points. So we'll see what it gives us here. I'll mark it too so we can see it in the 512. Might get a little cluttered. See if it's a fake out or if it's going to get some follow through. We did get, immediately spiked into a low tick. It's not a very low tick again, so not going to try to buy that up here at lows just because it's so early. We do have, what did we have? Consumer confidence, I think, at the top of the hour. When I looked at the Case-Shiller's report, it said it was delayed. I don't know if that came out or not. That was supposed to be before the bell. I did switch my trade log to a Google Doc instead of Excel, so you don't have to download it every time. And I'll just paste the trades in there. It's a little bit more cumbersome to do the like the monthly totals and some of that. Excel seems to be a bit faster, and some of the shortcuts that work in Excel don't work in Google Docs or Sheets. So I'll try to keep that updated too. But it's there if you want to take a look. We didn't, when this happens where how close did we get to come on. We came up to 46.12. The 50% was 46.13.63. The fact that we came down already to its negative 23, even without hitting the 50, we're kind of in a next retracement situation, as opposed, you can bring the anchor point down like this, but I'd be more inclined, well, let's start with that. We'll keep the full in mind and see how it develops. So for the other thing you can do is, one thing I'm looking at is do we break any swing highs? And we have a lower high, lower high, lower high, lower high. So the answer is no yet. We have to come up and break essentially 550. I have not been using a 4-point first target anymore either on the retracement trades. Yes, it gives you, a quick. I'm sorry, on the breakout trade, it does give you a quick, profit break even scenario, but having the extra contracts to get to plus 20 is way more profitable. So I'll move to break even if we go to plus 10, but otherwise I'm just going to leave it alone. Give it some breathing room and call it good. So if we would need to get to a 94, really a 93.75, but 45.94 would be 10 points from the entry price, and I'd be fine moving the stop to break even at that point. A little double bottom here. If we did come in and get a low tick, that would be a very nice double bottom play and kind of signal a fake out, but it doesn't look like it's going to happen. I'm going to get rid of the full halfway back just because it's kind of cluttering up the chart. None of these retracements have really traded, and that can be a sign that we're in for a little bit more of a ripper lower. Like we're not even making it to the halfway back. You might say we traded at like a 38.2 or something that I don't have on the chart, but we'll ride this 15-minute as low as it wants to, or as long as it wants to go. But otherwise, keep an eye on this breadth as well. So in a downward situation, if I were to draw the halfway back of the day, and let's say on the nicey tick, so let's say we start moving up here. Let's say on the nicey tick we come up and make a high tick. And we don't make it to the high price of the day, but we make it to the 50% retracement. That would be a good short opportunity. You're at a 50% retracement and you've come up into a high tick. Sometimes it lines up with the bottom of a 30-minute range or a 50%, but that's where leaning on the nicey tick can be a helpful way to kind of filter out various setups. Oh, is it too early? Yeah, I'm trying to short and we're not in a high tick, that sort of thing. So if we get some of those situations, I'll try to point them out. A little double bottom down here. No low tick at lows. 48 is our current low on the nicey tick back here. And low price is down here. We want to make sure when you're have a tiny setup like that you've also broke the 60-1/8 handedly. So technically that does give you the 2 ticks. You round up to quarter, you add 2, that brings you to 75. Wasn't quite quick enough to do a little long there, but we'll see if it gets any legs. This is where I would consider the little bit bigger swing high. When you have like a 1 candle, 1 or 2 candles in here, doesn't make for a super strong swing high versus like a couple of minutes of rallying and then rolling over. Let's see what we had here at the top of the hour. Yeah, consumer confidence and jolts. If we could hang out here today, like with a little isolated spinning top that's just, it doesn't fill the gap, just kind of hanging up here, then that could set us up for a gap down tomorrow, especially if we close a little bit bearish. Obviously, it's super early in the day, but that kind of a scenario where you break the 61.8, you get a bunch of late to the party Charlies jumping in, thinking, oh, I have to get long now. See, there's an uptrend. Well, the uptrend is so dang clear, it's way too late. Wait for the pullback. I mean, if your time horizon is 20, 30, 40 years, it doesn't quite matter as much, but we're talking from a swing perspective or intraday, we want to be a little more precise than that. But it is important to remember if you are managing your own, retirement accounts or long-term accounts, if you have different timelines for your accounts, which you should, separate them, then you don't need to be panicking over here with account A if the time horizon's, still 15, 20 years out. So that's one of the big benefits of segmenting your account, not trading super actively in your IRA. Yes, there's, you might have some tax benefits, but um, depending on your age, there's a lot of factors that would influence that decision for me. So I like to keep especially with 60/40 tax treatment, just keeping a separate futures trading account has always been my approach. Something mentally about it, just keeping things separate, knowing that if something happened, if my computer crashed and for whatever reason my orders didn't get filled on the stop side and things just went against me, that I'm protected. No movement on the nicey tick here, real quiet. Let's see what this consumer confidence jiggles things a little here. This would technically be that second 50% retracement, we'll call it, on the 5 minute. The first one didn't make it all the way to the 50, but that's where I said we might just see the second one trade because we went to the negative 23 so quick and it got a bounce. You kind of have to infer that, you know, computers, algorithms sold it early and then ran it to the negative 23. There's definitely a lot more of that in the last 10 years. I'm getting a little bit of a rip here. That's that full halfway back. Double bottoms and double tops are nice patterns. They have a very concrete low when both numbers line up, both legs line up at the same price. You have a defined swing high in the middle, And then the pullback tends to line up with kind of the swing high, if you will, like the 50%. The pullback kind of lines up with the cluster high in the middle. Drop down into a low tick. Drop down pretty quick, actually, but definitely in that funky, late to the party, FOMO buying situation with some profit taking and some, hedging coming in as well. And we may settle out with a breath that ends up more in that 1-to-1 range unless we can rip early enough, like rip to the upside early enough to turn this into a trending gap and go day. But the longer we sit here, because now we're within the first 30-minute range, 30 minutes has passed, so if we don't really need to, but if we mark the low and we mark the high, okay, that's the 30-minute range that I speak of. So if we stay within that, like we did yesterday, we stayed within the first 30-minute range pretty much the whole morning session, and there wasn't much movement. I mean, just by nature of the range being large these last couple of weeks, there was some movement. But when you look at the actual candles themselves, you have a lot of tails in here. And when if you're looking at the 512 tick chart, those tails tend to mean, if you're drawing retracements, that you're going to end up with a lot more, whipsawing stop outs, where you break the 61.8 and then you still roll over. You don't make it all the way to the negative 23, and then you reverse and you break the 61.8. So that's, in the middle of that range can be really, really choppy and hard to trade. We just broke into lows by a tick. Didn't get a new low tick. Let's see if we can get to that 94 at least to move down to break even on the 15-minute breakdown trade. Otherwise, this bottom of the first 30-minute range will likely have some actionable point, whether it's if we dip below and then we come back into the first 30-minute range, then taking a long down at lows, especially if you have a low tick, will give us an opportunity to maybe cross and go to highs of the day. But if we come down and break lows and don't get buying, like we don't pop back in immediately like we just did with that little one tick break, if we get below this 97, 45, 97 area and can stay below it, then, taking a short right there at the underside of the first 30-minute range is sort of like getting in on the breakdown. If you look at where the gap fill would be, that's a 70, so that's 20 points, almost 30 points away. I would consider that kind of an early short to the gap fill, if you will. As far as going long down here, now there is a double bottom forming. This swing high is a little bit weak because the candle doesn't really poke out much above the prior one here. So I'm not going to put a long order right here. But then if you wait all the way for this one to break, you're quite a ways away up here. If that broke and you drew a retracement long, you'd be way up here. You'd be already almost to the 50% short. So I don't think a long here is going to be. I think it's a little bit early. And yeah, okay, so we went another tick lower. We really need to like stomp lower, not just tick in and then have some buyers come in. If this thing wants to go, it needs to like have some oomph behind it. Otherwise, we may just peter out. Okay, I'm going to move my stop on the 15-minute trade here to break even. If you want to go like plus 1 point, that doesn't matter. Break even plus one, whatever allows you to breathe easy, so you can see it through to the 20 points. A lot of times, you know, being in a free trade or a break even trade just takes some pressure off, and if that's what it takes to allow you to kind of sit back and almost not think about it as much to get you to that 20-point winner, then do it. If that means you gotta do break even plus a tick for commission, do it. Now I wouldn't put it at +8 here because you chop around a little bit and get taken out. And +8 is nice, but plus 20 is much better if we can get there. And with the gap so far away, that's likely a possibility here. Didn't even really make it up into that next short either. But you see on, let's see, Chuck was commenting about breaking which swing high here would we need to break. Um, if you draw the retracement short, see how we didn't break the 61.8 even? So if you're trying to justify it and say, well, here this candle pokes above the prior candle, that's a swing high. Okay, well that's one check mark. If you want to really force it and say we broke a swing high, well then do a second check and make sure we broke the 61.8. Okay, well we didn't. So I guess I can't take that as a long. So you wouldn't want to come in here and draw up a long like this. And so kind of having those two variables, the swing high break and the 61.8, can help keep you in check and just make sure that you don't, if it saves you a couple of stop outs per week, that can be a big difference on a week that maybe doesn't have a big runner or something like that. So yeah, good question. Now here again, we didn't rally all the way to 50%, yet we came down to its -23. So it's like there's, that says to me more profit taking because, okay, the market's coming up. If I wanted to put on a short, I would want to be as high as possible. But if I was just, liquidating and taking some profits, as soon as things come up and, yeah, we're getting, we got a nice little bounce. I got a little bit spooked because we started to sell off. So, on the next bounce, I'm gonna take some off, and I'm gonna, I've already got a whole bunch of profit locked in. So here we go. I'm gonna just sell some, take some profit, and then boom, you get that quick rip down because there really wasn't much on the buying side, and then that selling just overruns, and it's like stair step, stair step. This takes 53, almost 10 minutes to go up, and then 1 minute you're all the way to the 61.8. Can I just get a quick mic check? Just make sure that everyone can hear me still. Mic check 1, 2. Okay, great. Oh, thanks, Juan. All right. So we need to go another. Well, the 20 points is an 83.75. Really, it's an 84, but in order to get that filled where your price is, you got to trade through it. So still have a little ways to go to get to that 20 points. But see, here's a high tick. And if we drew, I should have had this drawn up, sorry. Drew up the short like so. Sorry, I should have had that drawn up sooner. Um, and you came up into a high tick here. See how this nicey tick kind of relative to the other high ticks of the day, as an absolute number, it's not incredibly high, but look what's happening. The nicey ticks are trending down like this, and then boom, we get this high tick, and that is 710, and here we are at 710. So yeah, I really needed to take that short. And then we ran right to the target. Shoot. But that's the idea. You're looking for these relatively high ticks. We were trading down here, minus just under the zero line, and then boom, you get this high tick. So, any of these retracements, you could completely block out the nicey tick and just come in and draw up a retracement short and then draw the next retracement short. But rather than taking 30 trades, to start filtering some of those out, okay, let's make sure we break a swing high or a swing low. Let's make sure we break the 61.8 if we're changing trend. If we're continuing the trend, let's make sure that we're continuing in lower highs, lower lows, lower highs, lower lows. Okay, so you kind of run through just the basic checklist, and then that nicey tick can almost be like a confirmation, if anything. There are times where I'll have an order resting and the nicey ticks don't budge, and so I will cancel the order, and then you end up going higher and breaking through. Yeah, so if you're gonna do only ES trading, you do need like two separate accounts if you're gonna do the breakout trade, and there goes our 83 or our 84. Boom. 20. So the reason I use the plus 20 is because at this point, here's our 15-minute candle. Let me clean this chart. I'll come back to your question here, Robert, in just a second. At this point, when I was trailing my stop, here was the entry, the 04. If I was trailing my stop, it would still be at the -4 because this candle that has now just closed, it's a 46.07 and a quarter, so I could move my stop, one tick above that, which really doesn't change. It's basically -4. So I'd be sitting here with a -4 stop and unrealized gain of plus 20, plus 25 points. Now, sure, we could make it down to the fill and get a little bit more, but what if we don't? And so going through all of my trades last year, there were a couple that that were just knockout, plus 40, plus 50, just out of the park home runs. But you're talking maybe 3 in 100 or 3 in 50 trades. So still pretty low odds. But there were a lot more trades that went plus 22, plus 25, and then came back and I ended up with like plus 5 or plus 8. So looking at all the numbers from last year, and obviously if volatility was not this big, you wouldn't be having a plus 20 move in a half hour or sometimes 10 minutes. But so plus 20 was a big number before 2022 started, and thus using that as a target from a profitability standpoint made more sense. So if you were going to trail, or if you were going to take one off at, or half of the position off at plus 20 and trail the rest, you need this candle that just started here to close, and then you could put the stop above this candle's high, which currently is an 88. So 45.88 and a quarter, that would be your stop, and then you would just keep trailing those 15-minute bars. I did look at some other methods of trailing 5-minute bars, and on some days the 5 minutes were clean, but and then days like today, you'd be stopped out when you break above the high to low bar, way up here, almost basically at break even. And so keeping it simple, keeping it very few moving parts on a day where, okay, yeah, I missed that retracement short there at 710, but otherwise there really weren't, in my assessment here, too great of short opportunities. So, and you take a plus 20 and you can go out and head to the golf course or go ride your bike or whatever whatever you like to do. Honestly, I sometimes there have been a few cases where yeah you get in the trade and it's like okay I'm trailing my stop and okay now we're 2 hours into the day, 2.5 hours, and it's just one of those like consistent trend day all days. Um, Sometimes I'd rather just get stopped out and go about the rest of my day. So those don't happen too much, but rather than sit here and try to get a plus 25 by a trail stop, you have to have your stop. Let's say you have 3 inside bars, you get a bear flag here, and then you move lower. Or if you just chop around for a while, I mean, you're spending a lot of time just waiting, waiting, waiting. And yeah, there's something to having the patience to wait, but with a -4 stop and a plus 20 target, that's 5 to 1. So from a numbers perspective, that's fantastic reward to risk. You could have 4 stop outs and 1 winner and still be positive on the week. So, and again, that's why that taking that +4, great example of that today. If you traded 2 contracts, you'd have +40 versus +24. So carrying that second contract or that fourth contract or however many contracts you're trading, carrying all the contracts to that bigger profit target is going to make up for, you know, the extra -4 you take because you aren't at break even. Oh, and then so going back to Robert's question, if you're gonna like if I had taken this short in the same account that the breakout was in and they were both on the ES, yeah, I would be double short. Or if I had 4 contracts short and then I put another 4 at the halfway back, okay, now I'm 8 short. So I know a lot of people have been doing like a combination of micros with the retracements and then just trading the regular ES, the mini, with the breakout, and then you can do that in one account. Otherwise, yeah, you have to have 2 separate accounts, which by all my research is by no means illegal. I mean, you can go long in one and short in another and be net even, I suppose, and you wouldn't make any money, but you'd be right on one of the trades, I suppose. So yeah, if you could have 2 separate accounts, or you could trade different markets, or different. You could trade the micro and the mini, but um, you don't want to get stuck on the micros forever. So doing +20 and trailing the second half is a reasonable thing to do as well. But going through my numbers from all of last year, especially when volatility wasn't as big as it was this year, just knocking out that +20 was a considerable difference, not just like a point or two difference. It was very different. And so +20, when I'm talking about the ES, I'm talking about 20 points. So if we're talking, there's 4 ticks per point: quarter, half, 3/4, even. But don't look at the tick chart for that. Look over here on the the 15 minute. So, okay, 87.50, 87 and a quarter, those are all ticks. 86 and a quarter, what's it? Eyes here, 87, so 86.75, 86.50, 86 and a quarter. Those are ticks. So you're talking 12.50 a tick. The point is 4 of those ticks, so $50 a point times 20 points. So 20 point target, 4 point stop. So per contract, you're talking $200 stop, and then $1,000 target. So 5 to 1. And then just rinse and repeat. And there will be a handful of holes where you, like yesterday, you fill the gap, and so you don't have a trade. But that's okay. I think repeatability is the more important thing. I mean, it's been, let's see, 5, 6, 7, yeah, almost right at 15 years since I've been doing this, and even longer with some of the swing trading stuff. So being able to repeat is much more valuable than, unless you just made a whole bunch of money on one trade and then you just cut your position size to nothing and then just played. Uh, I guess you could bounce around, try different stuff, but otherwise, for the rest of us, long term is what we're going for here. And along the way, you will make some trades that end up being big home runs. Bitcoin was kind of mine here. Maybe you did get in on some GameStop or Tesla, you know, um, and then you have those. So if you're always kind of active and involved in the markets, yeah, not every trade's gonna go. I was early on the put hedge that I put on last week, but I just closed it out the next day because it didn't go down, and took the little loss and move on. So if you can kind of keep things manageable and just don't be so stuck in having to be right, then so what if you take a little bit of a loss? Better than taking a big loss. And if you can then repeat it, then there's not this fear of like, oh, I could be wiped out on this trade, because you're just taking little losses and then giving yourself opportunities. As far as the trade journal, I just use Excel. So on my other screen here, I've got this journal, just a very simple Excel chart, and then put I put that on in the dashboard, but I just switched it to a Google Doc, so you could save the link, and then I will just paste my trades into that doc. It's just a little easier to view, but I don't like Google Sheets as much as Excel, especially for like the recording of, or like calculations and stuff. It's just a little bit slower and clunkier. Not much, really not much going on here on the 512 as far as shorts, just kind of in a bear flag. A little easier to see on the 5 minute. See how each candle is within the big body candle. That's another good sign that if you're thinking, oh, should I be taking a trade? Like on the 512 here. Well, when you have inside bars, meaning you have one big candle and its high and its low encompass the high and low from the following couple of bars, it's hard to come in and take a long or even take a short, because you're just moving sideways in a chop zone. Now, if you're corresponding with an icy tick, at the very least, these high ticks are lining up with kind of these spikes towards the top of the range. And that's where the nicey tick becomes really, really helpful when you're selling high ticks towards the top of the range. or buying low ticks at the bottom of the range, you're going to have much better success if you can incorporate the nicey tick on, especially on those range bound days. And you can look at, like I commented earlier, see how the nicey ticks were downtrending here, and then we spiked up. Okay, that's a very clear break of the downtrend, spike up, and that was that short uh, that I missed there on that spike. So, and that's one where you just kind of have to spend time looking at the nicey tick and looking at the chart. There's not really a fast track to avoiding that screen time. All right, let's clean this up. I'm going to get rid of the 15-minute line. I've got the high and low of the first 30 minutes. So let's see what happens when we get up to the underside of this 30-minute range here. Our full halfway back of the day is not going to be aligned. It's going to be within the first 30 minutes. So if we came all the way to 46.02, that would be a clear break through the 30-minute low, and we would likely be able to trade to highs of the day. You should see some reaction at the 50% when it's the halfway back of the day, but let's say it was more like this, where the 50 lined up down lower with the 30-minute low. Okay, now you have a likelihood of a strong reaction there. So we'll see how we do here. No low tick at lows, which would signal the low of the day, 14.06. We still have that unfilled gap below us. Nothing, I mean, if you took this little hammer swing to highs, you could maybe justify we're bouncing at a 50% here, but that's a little bit of a stretch. I think more so we're just getting some selling and some late to the party buyers, and our breadth and advanced decline line really have not changed at all from the open. I tend to update the trade log maybe once or twice a week when I go in there and post the weekly videos. Now that it's I mean, what I will do is make a couple notes of like the time that I'm placing the trade and the direction, and then once the session's over or if there's a lull, I'll come in and fill out the rest of the, like I like to record, okay, the max profit on the trade. That's what helped me determine the 20-point target for that the 15-minute breakout. How much heat I took on the trade, that kind of stuff. A quick note, just a little couple of words or a sentence, just to kind of refresh my memory, because I've almost trained myself to kind of forget about the last trade really quickly. So as far as which 61.8 would you're looking at to break, go with the continuation of the current trend. So if you're coming in and you're just looking at kind of a blank slate here and you're thinking, oh, where's the trend change? Come back to where the retracements were, trading at the 50. Okay, this was the one. This is really kind of where we started rolling over pretty hard, and then, or sold off at the 30. Then you come in here and okay, we've got a move all the way to the 61.8, negative 61.8. So we can draw an extension, which we can obviously tell that it failed. Okay, so now we have to go to the full halfway back from that original 50 drawing, like that. So then you say, okay, well here is the 61.8 break. So all of this junk under here, I don't want to be trading. I don't want to be trying to trade this short because, stop out, stop out, stop out. And I also don't want to be trying to trade it long because, there, boom, broke the 61.8, stop out, stop out. So you draw it up like this. Here's your reference point of the 61.8, and oh, it happens to be the swing high. So once that 61.8 breaks, which it did over here, and that swing high is broken, okay, now we can consider a trend change in the long direction. But in a situation like this, okay, we're well off lows already. So, the up move, it's one of those where you're almost better waiting for the short to come into play. Kind of whichever one trades first, you can go with, but when you make a move this big, and there's not really a long opportunity at lows, sometimes you'll have a low tick down at lows, and you're able to get in a long pretty early. But at this point, if we bounce off the 50% long here and make a little double bottom, okay, you can maybe draw up a long, but look what we're running into, the underside of the first 30-minute range. So more than likely, these 250s will kind of be support and resistance levels, and you could bounce off the two of them again and kind of be stuck in what we've been in all day. Just a little bit more of a choppy environment, even though the trend is generally down. And that this is the whole premise of why I was trying to put something together that could get me into a trade early with the trend, and I could capitalize on a move without having to take excessive risks and risk all these little trades stopping me out when it's just a bear flag or some kind of consolidation that isn't the cleanest of setups. Let's see. If you go to EminiMind and search Nicey Tick, I have a post. If you're using Thinkorswim, this Nicey Tick chart, you can get that data. I think when I share my workspace, I don't know if it pulls in that tick study or not. I'll share it again just to share it here. So that's the TOS workspace that you see here, but you may have to pull in the actual TOS study itself. If you do $tick, you can get the tick chart, and I basically have it as a 1-minute bar chart with the plus 1,000 and minus 1,000 and the zero line as just price levels dotted for plus and minus 1,000, and then the zero is just the solid light gray line. But to get these sort of continuing low and high lines, that's in kind of the study itself. And right as I'm talking about that, we came up into a high tick. If we go back to that 15-minute chart, see how this candle is inside the prior candle. So had I been trailing instead of doing the plus 20, basically the stop is at -4, and that's okay. You might, if we can run down and fill the gap and get a candle with its high, that's down here in the low 80s, you can end up with more. Or let's say you run through the gap fill, you could end up with a trade that ends up more than 20 points, but the candle high needs to be below 84, or really like an 83.50. So I wouldn't put my stop above this green candle because it's inside the big body candle. So this is just an inside bar. And that is a very helpful way to stay in swings longer. Yes, trailing each candle is good, but when you get to a bar where the next one does not break the prior candle's low, then just leave your stop alone. That part seems to be, leaving your stop alone seems to be hard for a lot of folks. So but if you make a mistake, it's okay. Write it down. Keep a notebook or a legal pad or something. Write down some of those mistakes or write all the mistakes that really irk you, get you, pounding your desk and frustrated. Write it down. Review them each morning before you trade. Don't make that mistake again. It's okay to make it once, but don't keep making the same mistake. Then you can see some really fast growth. Consistency is your best friend. You can't be jumping all over the place and then trying to take those trade results and make sense of them. You have to be consistent so that the data that the trades are giving you is actionable. If one time I was doing plus 20, and the next time I did plus 10, and then I moved my stop to break even at 10 points, and the next time I just moved it to break even at 4 points or 5 points, and you're just all over the place, then when I'm looking at the results, it's going to give me, I'm going to come to conclusions that aren't accurate. So now here we're in a low tick of the day. It's not the low price of the day, but at this point, I would expect us to keep going lower here. And we're not really at a 50%. So just you have to really become proficient and be extremely sound in your sticking to your stop and exit parameters if you're going to just be buying low ticks just because it's a low tick. You can get away with a really, really tight stop in these kind of situations. A 1 or 2 point stop, you buy the low tick and you get in a couple ticks off of lows with a 1 point stop or a 1.5 point stop. But you can't sit there and let it just rip through and then all of a sudden be down 10 points because it didn't stop where you thought it was and you didn't use a stop. Doing something like that is a bit more of a scalp. I mean, if you're doing let's say a 1.5 point stop and a 3 point target, okay, yeah, it's a bit of a scalp just because of the shortness of the trade, the duration of the trade, but the reward to risk is still much better than, a 3 point stop and a 2 tick target, or a 3 point stop and a half a point target. I don't really see much on the 5 minute other than the full halfway back at this point. Kind of in similar fashion to where we did not trade at the 50% early on, we have not traded at the 50% of the full halfway back either. Kind of been the pattern of the morning. And yeah, with 15 minutes left, it's likely I won't take a retracement trade here. I missed the one earlier, and it's like in order for things to set up into a good short, other things would need to happen. If we came down and double bottomed here and made a low ticket lows, you could make the case for a long, but to be so close relatively from where we opened to the gap fill, it would make sense. And we've sort of traded the halfway back short with a target. Look where the negative 23 is, right on top of the gap fill. So we should be able to make it there, especially if we can stay underneath. Let me get rid of some of these. Stay underneath this 30-minute range. To make it down to the gap fill. So yeah, I know sometimes it seems a little bit boring, but if you get into that mode of just buy sell, making 50 trades, and who knows what, the commission, even at $1 or two, um, if you're only taking a couple ticks at a time, and then boom, you have a 2 point stop, and then make a couple ticks, boom, 2 point stop, like that would stress me out to the moon. Not to mention not be profitable. You're fighting with computers that are doing that way better than you ever could. A human could, when you're talking super small and quick movements. So I'd much rather have 2, 3, maybe 4 trades a day. On a day like today, just one. Had the opportunity for another one, maybe 2, but I kind of missed it. Just gabbing instead. But you pair this day trading with the occasional swing trade, you build up a long position, and most people aren't coming out of college starting to day trade, at least most of the folks that I talk to. Um, I was in a little bit of a different situation, and even there, I'd been working for a long time as well. So I had some money banked up, and but if you got a 401k already going, building that, kind of almost putting yourself on a cruise control towards, you know, if you have this idea of early retirement, or, let's say you're in your 50s and things are kind of, you've been working for 20 plus years and things are going pretty good, and you're kind of thinking about making it to retirement. Um, it frees up your mind to be able to focus on trading well instead of stressing about the dollars. Look at this trend line here connecting. So if we can break, let's say this swing low right here, just because it's the most recent low point that kind of sticks down here. If we can break that low, we should have no trouble getting to this gap fill. Doesn't get much clearer than that. But all this little stuff you hear about habits and routines and mindfulness and your James Clear and your who wrote Hal Elrod, Miracle Morning, James Clear, Atomic Habits, Brad Stolberg, Peak Performance. All of these books that talk about high level performing. So much about being in the right headspace. I listened to another good Tim Ferriss podcast. I haven't really listened to many of them, but that Morgan Housel one I thought was really good. It was super. It just felt like everything he was saying was all the stuff that I uh, have believed and done for years. But with Hugh Jackman, actually, the actor, um, boy, is he a cool guy. Just as far as his life philosophy and how he got to where he is, and he listened to his routines and his discipline and all the stuff that he does on a daily basis. It's you know you say believe and you can achieve. Well, you believe and you start to do these little things day after day of some simple notes about your trades, keeping that mistake log, if you will. Don't kick yourself for making the mistake. Just okay, you made it and move on and just make sure not to do it again. All that stuff would really help you grow in a very fast manner. Yeah, I should read Morgan's book. I have not read it, but I thought the interview was really good. I being younger, for those that have lived through like Vietnam and especially the 60s, people talk about how crazy you know the country is right now, and but from what I'm told, for those folks that grew up in the 60s and things were pretty animated, if you will. And so my thoughts on this whole Russia-Ukraine invasion is that there were going to be a lot more, or there are going to be a lot more repercussions similar to the higher gas prices that would make it hard for folks to pay for things. And yeah, it just seems like flip of a switch and boom, we're back up to talking about going to all-time highs again. It doesn't seem to quite add up. Well, I think we'll leave it at that for today. I'm likely not gonna take something here. These swing lows are pretty clear, so if we break, I mean, occasionally I'll do just a sell stop or a buy stop, like in this case, below some kind of low. Usually, if it's more of a horizontal low versus like, higher low, higher low, higher low. But yeah, this trend line here, just if we can break that, we're kind of getting pinched here between the 50 and this uptrend line. Now, it wouldn't at all surprise me if we just go screaming and then break highs of the day and continue our rally back to all-time highs here. But as far as a clear breaking point, yeah, breaking this uptrend line should be able to take us to the close of yesterday. Now, breadth and advanced decline line being the exact same as they were when we were trading up here would signal that we could return to be trading up here again from the open. Um, Trading lower with a strong breadth advanced decline line, even stronger in the AD line here, and breadth. We were like 2 to 1, we're at 2 to 3, so 2.3 to 1. So, yeah, wouldn't be surprised at all if we go higher, and I'm not going to stand in the way. I do have that small put position just in case something happens, but didn't really cost much, and I kept it small. And obviously, going on the upside here, the long position, that VUG, it's just like taking off. So you don't want your put position to be bigger than the long position that you're hedging. Ideally, it's pretty small and almost insignificant. But the reason you buy puts is because, okay, volatility is really low. If all of a sudden volatility spikes, the puts go up in value just from that. And then if we move down, they obviously go up in value because they're getting more in the money. So it's almost like this curve where, yeah, you lose a little bit of money if it goes against you, but you make a lot more if it goes your way. If you just buy them and hold them till they're worthless, well, that's not smart. You'll lose all your position in that case. But the most you can lose is whatever you paid. So if you paid $250 or $3 per contract, so $300 per contract, the most you're risking is the $300. If it drops, it goes against you, and you get out for 225 and you lost 75 per contract, whoop-de-doo. But if it goes to $1,300 and you made $1,000 per contract, or even $800 per contract, again, the reward to risk is what we're going for, and you keep that in your favor. And so what if you take a few losses? The handful of winners can easily outweigh those losses. So that's the idea there. Next week we're going to do the session on Thursday. I'll be trading on Tuesday, but I'm going to have some family here still, and I just didn't want to be didn't want to be distracted. So next week we'll do Thursday trading session. I'll send out a note about that as well, and put a note in the dashboard. But if you have questions, as always, throughout the week, just shoot me an email, tim@EminiMind.com. Hope everyone has a great week. I'll put this recording in the dashboard as well. You can see all the other recordings going back a couple of years, it's like 10 years now, if you really wanted to. Go back and watch the old sessions. So hope everyone has a great rest of your day, and I will talk to you all soon. Thanks so much.